In a way, we've had the easy part of the tightening cycle. When interest rates were very low, it was easy to get back to neutral. Rates are now above neutral in most countries, so it's much more difficult for central banks to calibrate from here. Ultimately, the amount they need to go further from here will depend on the economy. If the economy remains resilient and inflation is sticky, there's more to do. But if things start moving back into balance, they're probably near the peak now. The US economy is slowing, but it hasn't gone into contraction as yet, but we still think it's coming. The key thing here is that there are long and variable lags of monetary policy. So monetary policy has been tightened, the economy is slowing down, but history shows us that it's normally a really big gap between when the yield curve first inverts and recession arrives. And interestingly, the median gap is about 15 months, which is about where we are now. So we still think that the recession's coming. We think it'll probably happen sometime in the next 6 months, but there is a lot of uncertainty about precise timing. So China's actually followed the pattern as we've seen in the rest of the world. They had lockdowns, then when they reopened, the services economy bounced quite sharply. But the manufacturing sector was already strong in China, so the expected rebound in manufacturing didn't happen just because the level was already very high. The second part with China is that they have not stimulated to the degree that we've seen in the West. So now things are slowing back down again. We think they will do some more stimulus. We think they will stabilise growth, but we don't expect a really big rebound. So the Euro economy has had a really difficult time over the last 12 months. They had the big energy shock, and now they've had a really big increase in interest rates. They've had a mild recession over the first 6 months of the year. Interestingly, in the near term, it looks like activity has bounced a bit, but we do think that as monetary conditions continue to tighten, activity will continue to contract over the second half of the year. Australia in many ways is still lagging the rest of the world. The economy has been resilient, the consumer's held in there, but the central bank has now increased the cash rate by 400 basis points, and that is starting to weigh on activity. We think they've got a little bit more to do, and the combination of tighter monetary policy and a slowdown in the rest of the world will mean that growth will slow further. In Australia, it's still a coin toss as to whether we have a recession, in part because population growth is so strong, but it is going to be weaker over the next year than the last year. So the equity market's really interesting at the moment. As central banks started to tighten, we had a really big fall in equities. The S&P 500 in the United States fell by 25%, but they bottomed out in October last year and have actually rallied a bit over 20% in the period since then. In many ways, it looks like they're starting to price an economic recovery, and that's exactly what we're seeing in housing markets as well. So it's kind of interesting that those two risk markets are moving together. But I think given that monetary policy works with a lag, and central banks have probably got a little bit more work to do, the risks are that the current rally runs out of steam and that we have further downward pressure as the year comes to an end. The global economy has had a really unusual period over the past couple of years. We had lockdowns, we had a big stimulus. That stimulus overheated the economy, and now central banks have pulled the handbrake. We think that the economy will continue to slow, but there is a lot of uncertainty around that. So we need to look, we need to watch, we need to observe, but we need to be ready for that slowdown when it comes.